Rick Santelli here live at CMEHQ with the breaking news of the morning. Some of the Fed's favorite news in terms of inflation. Personal income and spending and the PCE inflation numbers off for June. Headline coming in light on income, expecting up 0.4%. Cut that in half. Up 0.2. Up 0.2 is actually the lightest of the year. You have to go all the way back to October of last year to find a smaller income number change. On the spending side, pretty much nailed by economists and analysts, expecting up 0.3%, comes in up 0.3%. And I do want to point out that revisions are trickling in. Income had a strong last month, up 0.5%. It's now reduced by 0.1 to up 0.4. On the spending side, double. So we end up with up 0.3. Last month's up 0.2 moves to up 0.4. So spending doing much better here, and we have a consumption economy. But accounting for inflation, real spending comes in a little light at up 0.2. Last month upgraded from 0.3 to 0.4. Now let's look at the index. PCE, month over month, up 0.1 is expected, and that's a bit higher than the rearview mirror, which was 0. And if you have to go back and see when the last time we were a little bit higher than 0, that would be April, just a couple months ago, when it was up 0.3%. Now, if we look at the year-over-year PCE price index, up 2.5 exactly as expected, 0.1 lower than the rearview mirror, which was up 2.6. 2.5 equals January and February of this year. To find a lower number, though, you have to go into the Wayback Machine to February of 21 when it was 1.9. Now let's look at the core numbers. Start out with month over month. Expecting up 0.2%, comes in as expected. That's 0.1 warmer than our last look. Our last look was up 0.1. To find a number greater than 0.2, you have to go back a couple months to March of this year. And finally, the core PCE year over year expected up 2.5%, 0.1 hotter, 2.6, which equals the rear view mirror. But here's the good news. Even though we didn't make progress there this month, if you look at 2.6, that is the lowest level back to back, the lowest level going all the way back to March of 2021 when it was up at 2.25, which is, of course, is lower, but still we've made nice progress. Here's the issue for the Fed, and it's the same issue. This is their favorite indicator because for the most part, it always seems to come in a little lighter than other indicators like CPI. However, even though we've made very good progress on the longer view runway, if you actually look at this month, and in many ways yesterday's inflation numbers and the GDP pricing index and PCE were very similar, we have had periods in the past where we have made a little bit better progress, but especially on the core year over year, at least it stayed the same, and the comp goes back to the Wayback Machine. You see that yields have moved lower on this, and that really is the tell here. So the market seems to be comfortable with it. And what's fascinating is you look at 10-year right now hovering right around 422. Well, we closed yesterday at 424. We closed last Friday at 424. So whether you look at the day or whether you look at the week, we are now down 2 basis points. So really have been compressing. Longer dated treasuries are much closer where they settled last week. You look at a 2-year right now, it's trading 441. That's down 10 basis points on the week.